Companies have an ongoing influx and outflow of money. They need systems that record and manage what they own and what they owe. Let's talk about it. An account documents additions and subtractions for a firm's debts, profits, and ownership finances. The three account categories are asset, liability, and equity. These three accounts and their subcategories are found in a ledger record, with every account and its balance. Ledger records show the accounting equation of assets accounts equals liability accounts plus equity accounts. This is the fundamental equation and principle of accounting. In every business around the world, what the company has, its assets, are necessarily funded by one of two ways: debt or capital. So the equation must hold at any moment in time, and for every recording on one side, it must be a recording on the other side. For example, if the company needs to buy a new machine, the machine is bought for $100. The fixed assets increase by $100, and either the cash decreases $100 or the debt increases $100. But at the end, the sum of assets equals liability plus equity still holds. Asset accounts are those owned and controlled by a business. They are valuable because they represent benefits and income. Cash accounts that record a firm's growth and decline of funds like cash, coins, and money orders are an example of asset accounts. Another example is notes receivable, or notes that guarantee payment to the firm at a future date. Liability accounts note a firm's payment obligations, or debts. These funds are submitted to the firm's creditors, or companies and individuals who are owed money. Examples of liability accounts are unearned revenue, when customers pay in advance for products they have yet to receive through a subscription. Accrued liabilities, amounts like taxes and wages that have been accrued and not yet paid, are also found in liability accounts. Lastly, equity accounts record how much of the business an owner owns. One type of equity account is owner withdrawals. Owner withdrawals lessens company assets and equity because it is a removal of funds by the owner. Another category of equity accounts is net revenue. Net revenue is the proceed of the whole business cycle, and it is recorded in the equity files, increasing the equity. Many of the accounts we discussed focus on money that is coming in and going out of the business. However, debits and credits in a T account, a type of ledger account, is solely used to document the result of transactions. Debits are always listed on the left and credits on the right. Debit and credit alone don't denote an increase or decrease. Whether the transaction is an increase or decrease depends on the account type. This is where the double entry system, or the requirement for the accounting equation to remain balanced, comes in. For example, an increase or decrease in assets accounts must equal the increase or decrease in liabilities and equity accounts. Different kinds of accounts keep a business on track. Money management is the center of a firm, and today we put the account in accounting.